So for those of you who doesn't understand what rate cuts are, okay, so what does that mean? A rate cut, when you talk about rate, the Federal Reserve Bank, the main thing that you look out for when the Federal Reserve Bank minutes come out, which is called the FOMC, right, minutes conference. So when you take a look at that, the main thing we really look at rate cuts is the interest rates, okay, the interest rates do the bank, right? The US bank, what the Federal Reserve is going to do, because the Federal Reserve is the central bank that then lends out money to the other banks out there. So that's how the whole chain, the money supply starts to happen. So when you take a look at that, so we usually, most traders and investors will take a look at what is the Fed doing? Are they reducing the interest rates or increasing? Now the interest rates got a two side factor, okay? One is that if interest rates, right, are low, then it makes borrowing more simpler, okay? Borrowing more easier, isn't it? Because when you borrow, when you want to pay back someone, if the interest rate is very low, then you need to pay them back much lesser plus the capital, right? But on the other hand, when interest rates are high, borrowing then reduces, okay? So that's one thing in terms of reduction of an increase of interest rates on the borrowing sector. Now, on the other hand, in terms of, if let's say your money is just lying in the bank account as a saver, right, in a savings account, or as an investor, you just put it into the bank account, when the interest rates go down, that's not good for you, because then you're getting low return on your capital, right? Return on investment. Okay. However, when the interest rates increase, then there's an increased ROI. Okay.